So good evening, Bruins. My name is Megan Friedlander, and I'm one of the assistant directors here at the Alumni Association. Thank you for being here with us, and welcome to our presentation on investment basics and taking steps towards diversification and asset allocation. And thank you to Wescom for lending us their expertise this evening. Just a few things to mention before we really get started. This presentation is being recorded and will later be uploaded to YouTube if you want to reference any of the information again. And if you have questions for our presenters during the event, please submit them through the Q&A feature or the chat. And we have reserved time at the end for your questions. So thank you again for being here, and I'll now pass it off to my colleagues at Wescom.
Thank you again, Megan. Thank you for that nice introduction. My name is Sal Murguia, Partner Development Representative with Wescom Credit Union. I'm joined this evening by Martha Prado, our UCLA branch manager, Carl Gerstenacker, our financial advisor, and he's also a UCLA alum, David DJ Jebzinski, and he's our director of investment services with Wescom. And I'm also joined with my colleague in partner development, David Proctor. And we're here to give you an informative presentation on Wescom finances and investments, as Megan mentioned. Just a couple of housekeeping items. We are giving away 5 $10 UCLA store gift cards to participants. So we're welcoming participation in the chat. That chat's going to be monitored by David Proctor. And at the conclusion of our event, we will be awarding those gift cards to those who are participating. So we want to say, thank you for your participation. Thank you for taking time out and joining us here this evening. And without further ado, let me introduce David DJ Jebzinski, Carl Gerstenacker, the Jordan and Pippin of finances with Wescom. Take it away, fellas.
I'll be Jordan, if that's all right.
All right, good to see everyone. Hello, and hopefully everyone can see my screen okay. Let me just get a thumbs up or acknowledgement everyone can see my screen.
Yes, sir.
All right, perfect. Well, we appreciate the time this evening, and we have several slides to go through. And this event and tonight is all about everyone that's here. So we appreciate the time that you've taken away from family, from friends, from schoolwork, from work, from all the different things that you're focused on right now. We deeply appreciate it. So what we want to do is we want to cover several things this evening. We want to give you some information on the economy, on the markets, and then specifically break it down even more specific to strategies, diversification, and asset allocation. So we're going to get right into the material because there's a lot to cover this evening. And so hopefully everyone starts to see these slides move through. So as Sal did mention, I'm David Jebzinski, the Director of Investment Services here at Wescom Financial Services. And we are currently managing for our Wescom members just over $1 billion in assets. And our members are entrusting us with their retirement as well as other assets for future goals and objectives. So we have an opportunity to share some insight that we have on what's happening with the markets. And so we're going to get right into it with some of these slides here. So what's happening in the market, and is it volatile? Absolutely. Today was an interesting day. You probably looked at your phone, your computer. You probably got different updates right now on what's happening in the market. We saw a big upswing today in the market, over 400 points. There's a lot of factors going on that are causing this. We understand that we've been through and we're still in this pandemic that's happening. We understand that the economy keeps shifting from higher unemployment to lower unemployment. There's different policies that are changing. So we're going to talk about some of these things as we start the presentation here. So let me get right into some real meat and potato information here. So I first want to talk a little bit about what's happening with the consumer. That's all of us. We've all been through a lot in the last year. And so it's important to understand what the consumer looks like right now. So there's a lot of data on this slide. And really all I want you to focus on is a couple of things. Focus on the left side, and this is a balance sheet of someone that actually, it could be any of us. It basically is showing this. It's showing on the left-hand side assets and on the right-hand side liabilities. So just know this, that for every $8 right now that individuals are bringing in, about $1 is going out to pay for liabilities. That is, auto loans, liabilities, student debt. In fact, student debt right now is one of the largest, about 10% of overall household liabilities and debt. Take a look at the far right side or the top right. You're going to see debt servicing. Now, what does this mean and how does this pertain to what we're talking about tonight? Well, over the last year, we've seen this. We would love to be with all of you right now in a big auditorium and talking about this information, but because of the environment, we have to do this via Zoom. So many individuals are working remote. They're doing everything remote. And so what's happening is a lot of people are not traveling. They're not going anywhere. And so what's happening, people are paying down their debt. So if you take a look at this chart on the top right, it's showing if we go back to 2007, 2008, that was the financial crisis. We saw debt at that time about 13% of household after-tax income. So what this means is, although this pandemic has just been a very difficult time for all of us, both emotionally and financially, what it is showing is that our consumers are starting to pay down debt. That's a good sign. And we actually see that here at Wescom when our members come into the office, that because people are not traveling, they're not going places, they are starting to pay down debt. That's actually a good thing for the economy. Look at the bottom right side here. You're going to see household net worth. This is another important slide because what it's saying is because we're not going places, we're paying down debt. We're also seeing the prices of assets going up. You probably saw a headline that came out the other day. It said that real estate, biggest increase 10% in the last 8 years. You're seeing overall household net worth go up. It's another big plus for the economy, especially because it's been so uncertain over the last year. Let's go to the next slide. We know individuals, and I have family and friends that have been affected via the unemployment and what's happened in the past year. But look at this slide. It takes a look at the last 50 years and what the average has been. Unemployment's been around 6.3%. We saw a big spike up. So if you look at the screen on the far right, you can see that big spike. Well, that happened in April. Now, what's interesting is that number is coming down about half. So now we're getting to more of a normal unemployment rate. But really, to get back to where we were a year ago, it's going to take definitely more stimulus to get people back to work. We're also seeing some increase in wage growth because the fact that there's been less jobs out there, individuals had to pay more for individuals that are working. But I guess the good news on this side is the unemployment rate has dropped from 14 now down to about just under 7%. So another information on the economy. Okay, so we know there's been a lot that's gone on in the past year, especially the past 20 to 30 years. So this just shows you that no matter what happens with some of these financial crises that go on, the market is volatile. But what you'll notice is we do move through these crises on a year to 2 year basis. You can see March of 2020. I think everyone may recall, if you looked at maybe an investment statement that you had, you probably saw that in March, the markets were down about 34%. But what you'll also notice is it was one of the biggest recoveries in a bear market, which is when the market was down more than 20%. So let me show you the next slide, because I think this gives you a little bit more information. And again, we're just talking about the economy right now before we get into some strategy to kind of set the framework for tonight. So take a look at the slide. Again, a lot on this slide. A bear market is defined as when the market goes down more than 20%. Take a look at the left-hand side. You're going to see bear markets going back to the 1929 crash all the way up till the global slowdown, which is COVID, oil prices, all the different things that have happened. So February, March, the market was down 34%. This was one of the fastest recoveries we saw, which is 1 month. Which probably was an overreaction to the market. They're saying it did start the beginning of an inflation, but keep in mind, this slowdown preceded, what happened before the slowdown was 11 years of a bull market. Now, if you look at the far right side, you'll see bull markets and what they have done. The only thing I want you to remember about this slide is that bull markets typically last twice as long and they're 3 times as strong. So that's really what I want you to remember about this, because when you look at the duration, that's why we're here tonight, is to talk about long-term investing and staying in the course. So a couple things that are influencing the economy right now: inflation, interest rates. What's interesting is if you went out in last summer and tried to fill your car up with gas, I know we weren't driving anywhere. Gas prices were significantly lower. Now, fast forward today, In fact, I did have to put gas in the car on the last day. I saw the prices closer now to $4 a gallon. We're starting to see prices of gas come up. We're starting to see a little bit of inflation because they're saying there's a pent-up demand and potential for a opening of the economy. You're also seeing home prices go up. Like I said, oil prices. So we don't feel that this is going to be hyperinflation at all. We just know that rates were so low, there was some sort of adjustment that had to happen. So a couple things to think about for 2021 and beyond before we get into some individual strategies that you may want to consider. A couple things. We are starting to emerge from a slowdown and a recession, and we're starting to see that, especially today in the economy, today in the market. We saw a big upswing in a lot of different companies because of the fact that they're starting to predict that people at some point will go back to some sort of normalcy. We saw travel stocks, we saw airline stocks, we saw even Carnival Cruise, a stock like that. People may start to cruise again. Take a look at this slide here. A few other things that we should see. Number 4 is profits improving. There could be some inflation down the road, but we just heard the other day from Powell and the Federal Reserve saying, you know what, they're going to try to keep rates lower for longer. That's good for the economy. That's good for all of us. That's good for any debt that we may have too, because we're all paying on some sort of debt, whether it's a student loan, a home, a car. So keeping rates low is a good thing. There's a lot of stimulus now that's in the economy. In fact, there's a bill right now that's a $1.9 trillion stimulus bill that they're trying to look at passing. That will be another injection of money into the economy. And again, lower for longer on rates. But again, the whole purpose of tonight is just to talk through diversification. So with that, I'm going to turn this over to Carl, my colleague, and we'll go back and forth with some of the slides.
Thanks, DJ. Can you hear me okay?
Okay.
Perfect. Hi, everybody. Good evening. Like Sal said over at the beginning of the presentation, my name is Carl Gerstenecker. I'm the financial advisor that covers the UCLA branch as well as the Culver City branch for us. And thanks, DJ, for that kind of a good recap of the economy, of kind of how the markets are working currently and historically. What we're going to try to do tonight, guys, is really talk about what all that means when it comes to your personal portfolio, when it comes to you investing and building your wealth over time, right? And really what we're trying to do is just kind of cover these 4 steps that, you know, despite market fluctuations that happen, right? And despite certain investment risks that occur, by applying a sound strategy or just steps to utilize, you know, we find ourselves in a more effective way to build our wealth over time. So we're going to cover these 4 things here. The first one is developing a sound financial strategy, right? And the 3 main things that we're going to be talking about is your overall investment objective with a particular sum of money, right? What is the goal? What is the why? Why are we putting money away? Is it long-term? Is it short-term? That's what the second thing here is, the time frame, right? Investing for, let's say, putting a down payment on a home might look different than investing for retirement for some folks. And then the last thing here is risk tolerance, right? What is our personal risk or our taste for risk? If we're willing to take higher risk for higher returns, we'll talk a little bit about that as well. So the first thing here, investment objectives, right? So typically this is crucial. It usually is when it comes to investing overall. There's always an objective with what we're trying to do with our savings, right? A lot of times it can be, like I mentioned, saving or putting money away toward the down payment, right? Towards putting a down payment towards a home. It could be towards saving for college for our kids, or it could be most times for, you know, saving and investing for our retirement down the road. And so that is always something to keep in mind when you're investing, because that plays into how you're going to invest, right? Preservation of principle, right? If somebody says, hey, my objective is more so to protect what I have in this account, maybe not earn too much, but I'm just trying to protect and earn a bit, that will look different than if we are trying to be aggressive and invest in certain investments that, you know, have more exposure to stock and can be considered more aggressive. So we can go to the next slide here. So time frame, right? When we talk about time frame, that's another key component when it comes to how we're going to be investing, right? When we invest, like I just mentioned, short time frames typically mean that the amount of risk, right? How much risk we're willing to take, the type of investments that we may be utilizing, may be more on the stable and conservative side versus if, let's say, somebody's saving for retirement and they have many, many decades till they retire, then that particular account or that portfolio or those investments might look different, and you're willing or able to take on more risk if that's the case. So time frame is always very important to consider when you're looking at investing. And like I mentioned, risk tolerance, right? Now, the way I usually advise clients in terms of how to view risk tolerance, usually it's a good way. One good way is to think, okay, what am I willing, if 2008, for example, happened again over an entire 12-month period, how much am I comfortable with going down? Am I willing to ride that drop and let it increase in value again? Or, am I not going to be able to sleep at night, right? That's very important in terms of how much risk folks are willing to take. As DJ was showing here towards the beginning of the presentation, stock markets can be very volatile, right? There's events that occur in the markets, right, and the economy, politically, that can move markets, and it can get bumpy at times. A good example is last year, right? Just last year, DJ was saying from February 19th to March 23rd, the stock market just in that 1 month dropped close to 35%. That is the fastest the market has dropped. The market's never dropped that much that fast, right? But then the opposite was also true, where it rebounded and it went back up and ended up positive at the end of the year. So again, risk tolerance is very important to consider in terms of how you like to invest and grow your nest egg. So we mentioned risk, right? There's different risks to consider, right? And we won't dive in too much into these in terms of specifics, but a good example, like I mentioned, economic risk. Last year, we entered a recession simply because of the lockdowns and the shutdowns because of COVID-19, right? But there could be different type of risk, right? Another good example is if you're investing in individual stocks and you invest in one company and they're in the news that something negative occurred, and so there's a huge sell-off that occurs and the price of that stock tanks. Well, that's company specific risk, right? There's specific risk that we're taking with that particular investment in that particular stock. So it's very important to consider the different risks that are out there on certain investments. And we'll dive into this a little bit more, but diversifying your portfolio is a good way to alleviate some of those risks that you take. This is a good chart here for you guys to take a look at. I was actually really amazed by it. I'm looking at the haircut, that the cost of a haircut today, if inflation is 3% a year, and 20 years is going to be $81. That's pretty crazy. But this is a good chart to show folks the power inflation has, right? The cost, something that we can be pretty certain about is that inflation will occur, right? The price of things do go up over time. And so for folks that say, hey, you know what, I'm just going to kind of keep money under my mattress and not really look to invest because there's too much risk, understandable. But however, it doesn't mean that you're not losing value. You are, right? If the price of things around us is going up 2-3% per year and your cash is not moving, it's not growing, then the value of that in terms of its purchasing power is going down. So that's where investing comes in. That way we can try to keep up and exceed inflation over time.
Great, thanks, Carl.
Yeah, DJ, I think this next one's yours, right? This slide.
Yeah, it is. So I'll go ahead and take over from here. Thanks. Sure. Yeah, and so let's talk a little bit about some of the investment options. So Carl did a great job just talking about the strategy. Before we actually pick what we're going to invest in, let's just put some parameters around the risk and all the things that Carl just mentioned, which are very important. So let's talk through a little bit about some of the different options that are out there, because there is a ton of different types of investments. So a few things, if you look at the screen here, I know a lot of organizations in the past, they used to issue stock certificates, and Disney Company would always issue their certificates, and they were kind of cool. People would give them to their kids and grandchildren. And now, of course, there's a lot of work in getting a certificate out to someone. So it actually is electronic. It's held in a investment account. But you can see there's stocks, there's bonds, there's different cash solutions, there's mutual funds, annuities, ETFs. There's a lot of different types of investments. And so I think it just really comes down to what's appropriate for you and your risk tolerance. How do you feel about risk? And a question that we ask a lot of our members here at Wescom is, if they invested $10,000 And let's say next week or next month, that account went down 2,000, would they sell? If it went down 3,000, would they sell? If it went down 5,000, would they sell? Is really understanding the pain threshold of when you would actually sell that investment. The reason that's so important is take a look at this next slide. So you're going to see a lot of investments over the past 20 years. So you may be thinking, you know what, DJ, I like REITs. REITs are the highest return here at 11.6%. Sign me up. I'm putting all my retirement in there. Not a good plan nor a good strategy. Because keep in mind, although today's winners are today's winners, they may be tomorrow's losers. And so when you look at this chart, this is over 20 years. There's a couple things to keep in mind. You can see the orange area that shows the average investor. The reason that's only 2.5% is because of the question I just asked earlier. Sometimes when the market starts to go through its ups and downs, a lot of times either we don't want to put money in the market or we're in the market, and when it goes down, we get out of the market and it doesn't give us an opportunity to recoup what we actually lost. So we see a lot of our investors that we work with, the average investor actually doesn't do as well as sometimes the indexes or even a 60-40 strategy, which is one of the items on here, shows the light blue at 5.5%. So that may be a good way to diversify, as Carl said. But again, what's most important is just to understand, set that goal, set that time frame, and then don't touch it, knowing that, okay, it's going to go through some ups and downs, but I'm going to just stay the course on why I actually went into this account, which is hopefully for a long-term investment objective. You know, stocks over time have done extremely well to outpace inflation. We see that, in fact, many of us may have been successful on our own with finding that one stock years ago, whether it's Amazon or Google or one of these amazing technology companies that no one knew about, and now they are at record highs. So just know this, it's important to make sure that over the long term, you're finding a great solution that matches to what's important to you as it relates to risk. So let's say, for an example, you wanted to look at an investment. Let's say it specifically was a stock. There's a couple of things that you may want to consider when you start to invest and you want to start considering types of investments. These are two fundamental measures that are very important. Number one is called price to earnings. I think we all may have heard this, maybe in an econ class or in a financial planning class or something that we've heard about or saw. What's interesting about the PE is it just takes the share price and then how much the earnings are, and you get a ratio. So we can say, okay, where's the market today? Well, it's probably around 16 to 17 as far as the PE. Just know this, higher PE, there could be some potential risks involved. Lower PE, of course, there could be other fundamental things to look at, but just know price to earnings is something a lot of individuals look at when they invest. The second number on here is, you'll see 1.00. What is that? That's beta. So all this means is when we look at an investment, a lot of times what we want to do is compare the investment you're going into to the overall market. So let's say we're going into an investment and it has a beta of 1. And the market, of course, being, let's say, the S&P 500, it's going to be comparing it to an index or the overall market. What this is saying is a beta of 1 is saying the investment that I'm in will perform similar to the market, both on the upside and downside. So if I'm a conservative investor, maybe I'd want to find something with a beta of 0.5 or 0.6. That means that, you know what, if the market goes down 10%, I'll probably only go down 5%. But just know on the upside, the same thing will happen. The most important thing with investing is not so much how much you can make on the upside, it's protecting your losses on the downside. I always like sharing this quick example. If you lose 50% of your portfolio, so let's say you have a portfolio of $10,000, that $10,000 goes to $5,000. That's a 50% drop. What is the percentage return to get back to where you were? It's 100%. So what's important is to make sure that we don't have those drops in your portfolio. Now let's switch and take a look at a bond. So a bond is just a debt instrument issued by an organization. You can see here, let's say we had $1,000 and we're buying a bond, let's say it's 6%, it's going to give us some sort of income every year. So this is just saying that typically when interest rates go up, bonds can fluctuate. They can also go up and down, even though you're getting a set coupon from that bond. So again, just another type of investment vehicle to be aware of. And we see this right now. We see a lot of money going in from consumers, especially our members, into savings accounts, CDs, and money markets. A couple of reasons why. There's still uncertainty in the economy. A lot of us are still home and working remote and going to school remote. And so because we're not spending, that money is sitting in low yielding savings accounts. Now, these are well and good and make sense in everyone's portfolio, but just know what you don't want to do is have an asset that's a long-term asset in one of these short-term yielding solutions. And that's where just sitting down and going through some ideas makes sense. So another slide I want to show here, and a few slides from now, I'll turn it back to Carl. Taxes. Taxes are another thing. So inflation and taxes are two things that really can eat away at your overall return. So all I want you to remember about this slide is this. If you have a 401k or you've started an IRA, congratulations, because again, that's going to be tax deferred, should grow much faster than something that's taxable. Now, there's other more elaborate strategies we can talk about at a future date, but just know this, that inflation and taxes can eat away to the point where your return potentially could be negative. Mutual funds and ETFs, these are probably two of the biggest areas that a lot of our members like to invest in. A lot of individuals we work with at UCLA feel like this makes sense. It's diversified. I'm pooling my money with other individuals that are focused on diversified portfolios. So mutual funds basically are a pool of investments, and ETFs are the same way. ETFs work a little bit different in the sense that they're a little bit lower cost and you can trade them a little bit more frequent, but the objective is the same, is to diversify your portfolio and make sure that we're on the right track. Mutual funds come in all flavors, just like cars or even ice cream. You can buy a money market, a municipal bond fund, income fund, balance fund, growth. So if you take a look at this, there's lower risk, there's higher risk. Just know there's tons of types of mutual funds out there. And just sitting down with someone and going through it, we can just match up exactly what makes sense with your goals and objectives to what type of investment, such as a mutual fund. Something else to be aware of is just as you grow your account, there could be where you may have a capital gain or a capital loss. So all I want you to remember here is the 2 bullet points on top. If you hold an investment less than 1 year, that is going to be a short-term gain, and that's going to be subject to taxable income, meaning whatever your income tax rate is, you're going to be subject to ordinary income on those gains. Long-term capital gains are going to be a little bit more favorable. And again, if you're going to be investing, you want to look for long-term gains. Again, it's a little bit more tax efficient, keeping more in your pocket. Here's an example here. So it just lets you know, depending on your long-term capital gains. So this just shows, depending on your income range, if you're a single or joint filer, if you make more or less, depending on where you fall in this bracket, there's different tax rates. So again, short-term tax is always less than 12 months. That's ordinary income, whatever that bracket is. But long-term capital gains are a little bit more favorable. And these are always subject to risks, such as political risk. We do have a new administration in the office. There is potential that these rates could change in the future, but this is what they look like as of 2020. And I thought I'd put this up here for purposes of our meeting this evening. This is the 2021 retirement limits. I know it's a ton of information on here, but just know this. If you're in a 401k or some sort of 403b or 457, some sort of retirement plan, trying to do what you can to maximize your contributions is very important, up to the point where you're getting some sort of match. You definitely want to do that. And any individuals that are at age 50 or older, the IRS says, listen, you can actually fund more into your account, and they have a catch-up provision that actually for 2021 is $6,500. So with that, Carl, I'll turn it back to you.
Before you send it over to Carl, DJ and Carl, we have a question that came in, and I think it's a good point right here with you guys going over the financial strategy as well as the investment options. Kelly wants to know, her parents are 60 and they don't have much saved for retirement outside of their Social Security. Is there any advice that you could give her for them to invest their money and get a decent return but a moderate risk?
Yeah, DJ, if you want, I'll start.
Yes, go ahead, Carl.
So thanks, Kelly. I appreciate the question. Before I give any advice, I'd probably ask a little bit more about their situation in terms of that. And you don't have to answer anything like that, but I'd find out, hey, what other, if any, sources of income are there? I know you mentioned no retirement accounts, but if there's some sort of pension that maybe from a former employer exists, that'd be the first thing. Now, if they're close to retirement, and they're looking maybe to start putting away as much as they can while they're still working, it would be a huge focus on just saving, right? It'd be not so much on trying to take an unnecessary amount of risk with the investments, but maybe just, like you mentioned, kind of moderate risk in terms of their allocation, but really focusing on putting as much away as possible into retirement accounts like 401ks or IRAs. That would be the main piece of advice I would say. If the main source of income is going to be Social Security and retirement is not too far away, then we'd have to focus on putting as much away as we can from current income, and then also kind of controlling expenses when they do retire.
And something I'll add to what Carl just mentioned. Thanks, Carl. Great synopsis there. A few other things, as Carl mentioned, I think it is important to ask the questions. We see this with some of our members, and they may not have other income sources, but there could be real estate in the picture. So we'd want to know a little bit about their current living situation. Do they own their home? There is some options if they are homeowners. Secondly, if they are 60 years old, at 62, Social Security is an option to start. However, there could be where they delay their Social Security up to age 70. And of course, delaying your Social Security every year from age 62 up to the maximum age can increase your percentage by 8%. Your check will actually be 8% higher. So there's definitely a lot of strategies. What we see a lot, and Carl would agree, is we see all of our members, and in general, all of us are living longer. And so 60, quite honestly, is very young. We see individuals with 85, 90 life expectancy. And so there is some different strategies that we can put in place to make sure that there's some sort of income, but that may be delaying Social Security as well as taking a look at some other assets that could be out there. So great question.
That's a great point.
Thanks, gentlemen. And just let me add a shameless plug. If you're interested in following up with Carl or David and Martha, I'm going to put their information in the chat towards the end. I know Carl and David said there's some more questions that need to be asked. So you'll have an opportunity to follow up them via email or set up an appointment. I know previously questions have been asked. Is there any obligation? There's no obligation. There's no fee to it. They'd be happy to sit down with you guys. So look for that before the end of the session. So Carl, I'll send it back to you.
Thanks, David. Appreciate it. So, guys, we were just DJ was just mentioning that slide with retirement accounts and retirement contribution limits. It's a good segment to the one I'm about to talk about here. The main way that most of us or most Americans in general are exposed to investing is going to be through an employer-sponsored retirement plan, right? A 401k, a 403b, a 457. These are all essentially employer-sponsored retirement plans that we have. If you work for just a corporation or a company, or if you work for a school district, if you're a nurse, if you work for a hospital, a county, whatever it is, those numbers I just mentioned, those account types, they're employer plans that we have access to. And a lot of folks don't realize that bi-weekly, if we're getting paid every 2 weeks, what we're doing there is by adding money to these retirement accounts, we're not just saving, right? We're investing, right? We're buying shares of investments in that particular account. Usually they're going to be what DJ was talking about, they're mutual funds, right? and how David was just explaining, mutual funds essentially they're baskets, right? They're baskets of stocks and bonds inside of them. The more stocks that a mutual fund has, the more aggressive it's considered, the more growth it can experience over time. And mutual funds that have a lot of bonds inside of them are going to be more conservative, right? More stable, maybe not as much growth, but less volatility, less up and downs, right? So that kind of ties back to time horizon, risk tolerance, right? When are we going to need these funds? If they're retirement funds, are they for much down the road, or are you 60 years old and you're going to retire in 3-4 years, right? So those are things to think about. The slide here talks about just from a tax perspective, how different accounts are treated. Again, anytime we have a 401k, a 403b, any retirement plan through an employer or an IRA, which is an individual retirement account, a traditional IRA, those are considered tax-deferred accounts, right? And so any growth that we experience in those, any contributions that we're making, those accounts are tax-deferred. All that means is that as it grows, right, as you get investment returns, maybe make some dividends inside of this account, as it grows, as long as that account, or as long as the money stays inside of this account, we don't have to pay any taxes on it, right? We're deferring the taxes for down the road, right? And so that is different than opening up, a brokerage account, a TD Ameritrade, and adding money to it. That's a great thing to do, but just consider that it is, that would be considered taxable in the sense that it's not inside of a retirement account. There may be some taxes that may be due in the year that you invested, some dividends that might be paid out that might cause some taxable events. This chart just shows the difference between investing the same amount of money, $5,000 annually, into the same account, a taxable account and a tax-deferred account over time. And you'll notice that the orange bar there, that's the tax-deferred. It's a larger amount of money over a longer period of time, simply because we're not paying any taxes as long as we keep the money in there. That last blue chart just pretty much is showing what would occur if we invested over a long period of time in a tax-deferred account and just decided to cash it all out at once in the future. You'll notice that that blue bar is still higher than the green one, right? So we still have more money in a tax-deferred account after cashing it out than a taxable account where you're paying taxes every year on the account. So just the message here is just make sure that you guys look into any retirement accounts at work and definitely utilize those. Annuities, we won't spend too much time on annuities. These are investment types that are available to our members and to just the general public. But annuities essentially they're contracts, right? They're contracts with life insurance companies where there's certain guarantees, right? And there's many different type of annuities out there. The main ones we'll cover here briefly are fixed, index, and variable annuities. A fixed annuity is essentially it's a termed investment product, which means that you have to leave your money in there for a certain amount of years. Typically, on average, they're about 5 years that we have to leave the money there, and you earn a fixed interest rate on those. Think of a CD, similar to a CD, but any interest, any gains that you make in an annuity, they're also tax deferred, similar to a 401k or an IRA. Index annuities are similar in the sense that they are safety of principal investments. You don't lose any money if the market tanks, but we do use the market to measure how much interest you might make, right? So your money essentially mirrors the performance of a stock market index, and there are certain limits in terms of how much you can make. If the market goes up, we get a portion of that. If the market goes down, we don't lose anything. But keep in mind, annuities can be a little bit more complex than that. I'm generalizing a bit. Feel free to reach out afterwards if you have questions on these. Age is important when it comes to annuities. They're similar to IRAs and 401ks in the sense that 59.5 rule is very important, right? We can't pull money out of an annuity before the age of 59.5, otherwise there's penalties, right? Variable annuities are investment types that can fluctuate, right? They're similar to mutual funds where they can go up and down. And there's certain income benefits that you can attain from variable annuities. Might be something to look at if folks are approaching retirement and they'd like to turn their maybe a 401k or some savings into a guaranteed lifetime income while remaining invested. So again, more complex investments, but they are options for folks out there that want to diversify. So we'll transition a little bit here into maybe a little bit more specifics on tactics, right? On specific tactics that you can implement when investing either in a retirement account at work or outside of the retirement account. We'll touch on diversification, asset allocation, and dollar cost averaging. Those first two are going to be, they're relatively similar, right? The idea is that and DJ, we can go into the next one. From a diversification standpoint, the idea here is that we're not putting all our eggs in one basket, right? The idea of diversification is that we're spreading our investments so that way we spread the risk a bit. We limit the exposure to losses, right? By diversifying, I'll give you a good example. So a mutual fund is a good example of an investment that diversifies your money instead of investing in one individual stock, right? A mutual fund will typically hold hundreds of different stocks, whereas investing in one stock, we're at the mercy of whatever happens to that particular company stock. This is just it's a chart that shows different type of stock options that folks have when it comes to investing and diversifying their portfolio, right? Large cap stocks, those are going to be the big names that you hear about in the S&P 500. Small cap or smaller companies that maybe you take on a little bit more risk investing in them, but they can also grow substantially more over time. Dividend yielding, those are going to be stocks that provide a consistent dividend, and then companies that have been around for a long time. International stocks are pretty much what it sounds like, companies that are abroad. And low volatility funds, right? Mutual funds or exchange traded funds, investment types that are designed to be very stable, historically speaking.
Carl, while you're talking about the diversification, one of the questions that was asked is, are you able to make changes in your investment and retirement accounts anytime, or is it only during open enrollment? And then the second part to that is, if you leave your employer, what happens? Does that go with you or does it stay?
Good question. So yes, to answer, you're able to make changes to your employer-sponsored retirement plan whenever you want. If you have a 401k, a 403b, again, 403bs are going to be pretty much the equivalent of a 401k, but if you work for, let's say, a school district. A 457b is if you work for a county or a municipality. But in essence, you have the ability to. What I would do is I would find out who the retirement plan provider is, right? Maybe from HR, you can find out who it is, and maybe attain maybe a website, register on the website, and when you register on the website, you'll be able to see what you're invested in. Most plans that I see with my members, you have maybe 20 to 30 different investment options available to you, and you can kind of go in there and do your research in terms of what fits what you're looking to do from a risk perspective. David, remind me of that second question. Sorry.
So the second part of that question was, can you take it with you when you leave your employer, or does it stay with them?
Great question. So when you have a former employer plan and you leave the employer, most times you have four options. You could leave it if you want to. Depending on the employer, most times they allow you to leave it wherever, whatever provider they use. You could roll that over into an IRA, right? There's no tax consequence of doing that. You could move it to your current employer where you're going to be working, right? To the new employer plan that you have available. Or you can cash it out, which not recommendable because there'd be taxes and penalties, but that is an option. So those are usually the four options. So to answer the question in a more direct way, yes, you have options to move it if you want to.
Appreciate that, Carl. And then one other question related to this is, if you're a UCLA staff member, how does the pension change your investing strategy?
That's a great question. And one of those questions where it would take some financial planning and a nice sit-down meeting to answer, because it depends on the specific situation. It does change 100% the planning, right? Because there is, in the case of UCLA employees, you have a pension, and then you also have Social Security that you're contributing to. So those are two guaranteed sources of income coming your way. In my opinion, doesn't change the fact that I think folks should still utilize those retirement plans through their employers, right? Through Fidelity, I believe, is who you guys use there. But it does change in terms of maybe what you're going to be using this money or this retirement bucket down the road. Again, probably more of a great question, but a question that would probably require maybe a meeting or discussing more of that particular situation.
Appreciate it. So we have a couple more questions, but I will save those towards the end, and I'll let you continue with your slides. Thanks, Carl.
Sure, no problem. So in regards to asset allocation, guys, we were just talking about diversification, very, I would say along the same path, right? Very similar. Asset allocation is pretty much in reference to, from a percentage standpoint, how much are we going to have in one particular asset, right? Stocks, bonds, right? International stocks, domestic stocks, right? Cash, right? So the asset allocation for everybody is going to be a little bit different depending on many things, depending on your overall time horizon, when you feel you're going to be needing an account value, right? An account or an investment, your personal risk tolerance, right? Where you are in life, what is the goal with this money? This is just, again, many factors that contribute to how you're going to be invested, but asset allocation is a good thing to think about because it directly ties into how much risk you're willing to take and where you want to place your funds. This is a good chart to look at, guys. I won't spend too much time here, but pretty much it shows just different asset classes, right? It shows, you see a bunch of colors here on this screen, but you'll notice there's no real, I can't really, maybe if you guys can find it, but I can't find any sort of, I guess, rhythm, right? Any sort of stable consistency from these colors. You'll notice that they're all over the place. And the whole concept here is that on a year-by-year basis, assets perform differently, right? Domestic stocks, American stocks might perform much better than international stocks in a given year, but then the next year might be the other way around, right? In 2008, bonds perform much better than stocks, right? So, and that's usually not typical. Right. So the idea here is that by diversifying and by utilizing asset allocation, what you're doing is you're alleviating or spreading the risk a bit more. It's very difficult to time the market. I personally don't know anybody who knows how to do that well. The idea is to succeed in growing your net worth and growing your nest egg over time. Diversifying and continuing to save and add to an existing account becomes very effective over time. Lastly, we'll cover dollar cost averaging here. Dollar cost averaging, for folks that don't know, is the idea of pretty much investing on a regular basis, right? The idea that we are purchasing shares of an investment periodically through a particular interval of time, right? So that just means that a good example, actually, in terms of how to illustrate this is we do this if you have a 401k at work or a retirement plan at work and you're adding money, you are applying dollar cost averaging. You are every 2 weeks when you get paid are adding money to a retirement account and buying shares of investments at different prices, right? What that allows you to do is the intention or the goal behind doing that is to lower the price that you are, on average, lowering the price that you are investing in, right? And it also spreads the risk, right? Sometimes folks say, hey, I'd rather not invest this this large sum of money at one time because what if the market decides to go south within the next 2-3 weeks right after I invest? Well, by dollar cost averaging, adding money, maybe slowly over a certain period of time, you spread that risk, right? You buy shares of the investment at different intervals, and maybe it's a little bit higher at some point, maybe a little bit lower, but the idea there is to spread risk. And DJ, I think you're up, my friend.
Okay. All right. I'm going to bring us home here. I have less than about 7-8 slides, and we'll wrap it up in the next 5 minutes, and I'll turn some time over to Sal at the very end. So let's put everything together. We talked about a lot of information. We talked about the economy, the markets. Carl did a great job talking about assessing your risk, different types of investment tactics. So let's put everything together. So a couple things that we know from some of the slides we just went through. We know that stocks over time, and again, the longer period of time, in fact, if you look at statistics, over a 10-year period of time, over 95% of the time, over 10 years, you will see positive returns in stocks. You can take a look here again, go back to 1995, 10.2% return. Corporate bonds, less risk, less return. But again, looking at where some of money markets and savings accounts are today, this could make sense for a portion of your overall account. And then treasury bills. T-bills are those that are issued by the federal government. There's backing from the federal government. They are part of an overall diversified portfolio, so we can't discount them and just say, let's put everything in stocks. That's definitely not what we want to do, because you can see from the chart here in 2007 and 8, you saw the biggest decline in stocks because of the recession, the financial crisis. A couple things to keep in mind is, the markets can be unpredictable. Who would have thought, as Carl was mentioning earlier, February to March, we would see a 34% decline. I can tell you from members we work with and clients, no one really saw the 34% decline. But then here's the other thing. No one saw the rebound within the 30 days. That's another piece. So it's hard to really understand sometimes what the market is doing, but just know it can be unpredictable. But anytime you see the market down or your account down, I think it's important to revisit, okay, what is my long-term objective with this specific chunk of money? And what am I trying to do? A few things that we're going to cover in just a few of these slides is something that the market is spending more time on, and we're spending more time in our business now, focusing on what is called behavioral finance. Now, all that means is that there's different behaviors from different type of investors that come out during different markets. You could see when the market goes down, a lot of people get out of their investments. That could create opportunities because people are selling certain things and creates opportunity for others. There's other type of biases that we may have from prior investing experiences. So I guess a long story short, just know this, it's really time, not timing in the market that's going to make the difference. You can see here that if someone had bad timing, they would have missed some of the 12 best months in the market if you actually look if you go back 10 years. So sometimes it may be a month, a day, a week, just like today. We saw the market up 400 points. And we know today that we did see clients that potentially didn't take advantage of what was happening because of the fact that some people may try to time the market. So just be aware that it could become a bias. Again, confirmation bias, chasing performance, some of the headlines, panic selling. I mean, again, this is part of what is called behavioral finance that we're seeing more and more of. And we're trying to make sure that we're up to date on what that means and how we can really tap into the emotions of all of our clients and members we work with. It's very important to make sure that we guide everyone correctly and keep them from making a decision that may not be a great decision based on where the markets are. I can tell you, Carl and I did receive calls in February and March when the market went down saying, hey, what do I do? Now, what's interesting is when we had those conversations, it's revisiting, why did we open this account initially? It's for retirement. Are you retiring today? You're not? Great, then we're not going to do anything. But the other thing we did is let's look at the allocation. Is it allocated correctly? A couple things, and I just wanted to put up here as far as some quotes that you may have heard of. I like the one on the bottom here. It says, investing should be more like watching paint dry or watching grass grow. And that's really what it is, right? There's even some quotes that you may have heard out there that, Warren Buffett has said, where the market takes money from the impatient and gives it to the patient. There's a lot of different things out there, but just know this, revisit why you're in the investment and what your objective is and your time horizon. And I think that's going to help. So we want to put all this together. As David and Sal and Martha mentioned in the beginning, we're your partners here at Wescom. What I love about Wescom Credit Union is we are a not-for-profit organization, which means it is in our DNA to spend time educating our members, our clients, our community. That's what we do. So absolutely, there's a lot of resources out there. You can go online. You can just say, you know what, I'm not going to sign up for my retirement benefits. I'll wait. Or you can work with a professional. We are here as a guide, as a resource for all of you. And I really want you to know that. So I'm going to turn now the time over to Sal And Sal is going to take some time for a few of these slides.
Well, actually, David, I just want to make sure that we prioritize these questions. So I'm going to allot my time over to you. If we still have some time left over, I'd love to get to some of the housekeeping with the conclusion, but I really want to get these questions answered in the chat. So if you don't mind holding on a little bit longer, I'd appreciate it.
Yeah, sounds good. So David, if you want to open it up for questions, that would be great.
Sure. So you can continue putting in your questions in the Q&A. We have some already here that I will ask you, gentlemen. The first one is, there was a chart earlier that the average return for the investor was a 60-40 versus a 40-60. Can you guys explain that a little bit?
Sure. I'll jump in if you want, DJ. So that's just referencing the stock to bond ratio. So a 64, typically it's stock/bond, right? So stock to bond ratio. 60-40 means that a particular portfolio will have 60% exposure to stock or equity, they call it, and 40% to bond or fixed income is also another name for it. Versus 40-60 would be 40% stock, 60% bonds.
Thanks, Carl.
Sure.
The next question is, if the mutual fund options in my 401k, there's no employer matching, has a very high expense ratio of 25 to 50 basis points, should I still contribute to the 401k, or should I invest it in an index fund in a brokerage account instead?
It's a good question. I'll kind of give you my input. DJ, maybe you can chime in as well.
Yes.
In short, yes. 25 to or 0.25 to 0.5% in terms of fees. I guess you can say that might be a little bit high relative to like an ETF or an index fund. But overall, it's just in the industry, it's maybe not high for a mutual fund. But the way I would think about it is, what are your mutual fund options in your 401k, right? Maybe looking at those compared to what options you have within an index fund. Fees, don't get me wrong, fees are very important to consider when you're looking at investments, but it's not the only factor that folks should be looking at. Another thing would be, I'm a proponent of adding money to a 401k or to a retirement account simply by what we showed you guys here. Two things. One is that your money grows tax deferred, right? If any money going into a brokerage account is susceptible to any taxes. Albeit index funds don't have a lot of taxes that maybe you have to pay on an annual basis. Nonetheless, there's still the possibility of that. And the other thing is, just from a very more practical standpoint, with a 401k or an employer-sponsored retirement plan, it's all about automating it, right? Every 2 weeks or every month, however often you get paid, you're slicing a portion of your earnings before you pay taxes, before you pay your insurance, before you pay anything. You're slicing a portion of your earnings and you're moving it to this investment account. You're paying yourself first. Automating investing over a long period of time, DJ, you had a good slide there that showed that investing effectively over time is it's like watching grass grow, right? It's not super fun. It's not the most exciting thing, but it's very effective. And it allows your accounts and your net worth to grow over time. If you have access to those plans at work, I just think slicing a portion of your earnings directly from your pay and going into that investment account, because that's what it is. An employer plan is an investment account. It grows over time, tax deferred. That ends up being more effective, especially if you have good investments compared to investing outside. Not to say it's a bad idea to invest outside of a retirement account, but if we're looking at comparing, yeah, I would lean more on the retirement account if the goal is for retirement.
Hey, David, let me just add one quick point to that. That was a great question, because what's interesting when you take a look, and Carl had a great answer to that, but something else I'll just add to it. What's interesting is sometimes just looking at the fees of the account is one piece of the puzzle. The second piece is, and to this question, it really talks about active versus passive investing. And I think we could probably even put a slide up next time on this. So clearly index investing, and there's a lot of great research out there. Even some of the greatest and largest investors on Wall Street will tell you indexing is a good way to go. It's very less expensive. And of course, you're going to buy a basket of companies and just hold those through time. That's why the fees are very low. That would be passive investing. Active investing is you're going to hire someone on the account who's going to decide when to buy and sell based on what's happening. So every active manager that's out there is trying to do one thing and only one thing, and that is to beat an index. There's years where they beat it, and there's years where they don't beat it. Now, when you take a look at the last 11 years of the market, indexing has been very powerful because the market has continued to go up, and you've done it from a very efficient, low-cost way. The final thing I'd say on investing when you look at fees is there's an asset class out there that is definitely more expensive to manage, and that would be international investing or emerging market investing. So anytime you're investing outside the United States, typically you may see those specific investments within your 401k or 457 that do have a higher cost, and there's just a higher cost for doing business in those type of markets. But there is ways to reduce those costs through indexing, and there's international indexes that are out there that you can actually use. But great question, and hopefully we answered that.
Thanks, gentlemen. And along the same line, and I apologize if you answered it because I was going through the questions that were coming in, is this person was wondering, how would you recommend investing for short-term investment if they were looking at saving up for a home versus saving for retirement?
Yeah, great question. That would be where time horizon comes into play, right? And the next question I would ask is, what is short term, right? If short term is a year away, a couple months away, even maybe 2 years away, you want to be very careful in terms of investing when the time frame is that short, right? Because we've seen even with a relatively low risk investment approach, when you're investing in whether it's stocks or bonds, you are taking on a certain level of risk. And so for investing in a very, very short time frame, there's no guarantee that we're going up, right? If 2008 happens again, or if early 2020 happens again, and we need to recover, we don't have enough time to recover if those funds are going to be needed within a 1 to 2 year period. Now, if we're looking at, hey, I want to put money away and buy a home in the next, 5, 6, 7, 8 years, that gives us a little bit more options in terms of maybe what we can do from an investment standpoint.
Thanks, Carl. Next question is, if your employer offers a Roth and a traditional 401k, what are the pros and cons of each?
Yeah, well, great question. So I keep saying great question. They're all great questions. Well, it depends, right? If we have, in most cases, we're fortunate at Wescom where we as employees have this option. A 401k typically receives, if there's a match, if your employer provides a match, it usually goes to the 401k. They won't provide a match maybe for the Roth 401k. Now that's not universal. That might apply at other employers, but for the most part, that is the case. So you got to understand that the difference between the two, right? If you're getting a match into your traditional 401k, I would highly advise that you put money in, if you're able, match the match that they're providing you, right? If an employer is saying, hey, we'll match 6% of your contribution, it's advisable to put in that 6% if you're able, because that is an instant return on your investment right away, right? But that typically occurs with a traditional 401k. It usually doesn't happen. They usually don't match with a Roth 401k. However, a Roth 401k, it's not a bad idea to consider doing that as well if you're able to, because your money grows tax-free, right? You're contributing to this investment account, to this retirement account over time, and your growth is tax-free. So which one is better is a very specific question in terms of maybe where you are in your personal situation. As you'll see, most of these questions are that way, where it's important to find out more about the individual and their situation to properly answer it. DJ, do you have another something else you'd like to add?
Yeah, just something on the Roth and the traditional 401k. I think having that option is a great option. It all depends, as you were just kind of going through, Carl. A couple things to consider if you're doing a Roth. Number one is your contributions, of course, are not going to be deductible, meaning that you're going to use after-tax money. So if you're in a higher bracket, you need to take a look at what that actually means, and does having the deduction, or I should say pre-tax money, go in make better sense? We see a lot of individuals that are younger that like the Roth, because keep in mind this, money going into a Roth, the whole purpose is you want to grow it as fast and as long as you can because the earnings will come out tax-free. So for someone that may be in their 50s, 55, 60, it may make sense based on what their income earning is to go ahead and do the non-Roth. If you're younger, it could make sense to do the Roth, but I definitely would want to look at the income levels, do some analysis, and see. You can actually look at both and say, okay, will this put me in a higher tax bracket? But clearly, make no mistake, if at the end when you retire, if you can have your money be tax-free, that would be the greatest benefit. Because the hope is that at some point when you retire, your tax rate will be lower. But again, if you've surpassed a pretty good amount of wealth, it could be higher. So again, you want to really look at the differences there. But if you have those options, sit down and take a look and see which makes sense based on your income as well as where you're at and how many years you've been in that plan.
Thanks, gentlemen. And somewhat related to the question you were answering, and is this particular person's asking, they have the options of contributing to a 401k, a 403b, and a Roth 401k at work. They already have a separate Roth IRA started, and they're doing the plan max out by their annual contributions. Which accounts would you recommend opening or contributing to at their employer, if any?
That was a loaded question.
So and I can go back if you need me to. I know it was a lengthy one.
Yeah, pretty much it sounds like there are different there's different retirement account options at the current employer, and this individual has a Roth IRA that they're contributing to. It sounds like they're maxing it out. Well, again, you want to take a look at what your employer situation is in terms of whether they do a match, right? If there's, and I don't know, David, if there's a match, if they mentioned anything about a match in there, but if there is, go ahead, sorry.
No, there was no mention of matching.
Gotcha. If there's, I mean, that's the first thing I would say folks want to look at when looking at a retirement plan at work. What is the match? That should be the first question you guys should be asking to HR. What's that match look like? And then you can go into whatever plan provider they use at your job and take a look at the investment options available and start comparing, right? Seeing what's the proper investment approach that you can take for your age and for when you plan on retiring. But I would say in terms of choosing between those three options at work, you want to take a look at the match option there if it's available. If it's not, then obviously you have different options, right? You can kind of prioritize pre-tax. Then you would want to look at things like DJ was mentioning, your personal tax situation. Is it beneficial for you to contribute to a pre-tax type of retirement account because it will lessen your taxable income now and let your money grow tax deferred, and then you can worry about taxes down the road? Or are you in a tax position where it would be more beneficial to put some money away after tax and let it grow tax free? Again, a lot of information there, I know, but again, that's why that's why this information is on the screen. If you guys have any specific questions you want me to address or us to address, feel free. Any questions about your individual situation, please feel free to reach out.
And David, just to follow up to what Carl just mentioned, we really, when we approach sitting down with a client or a member, it's really the three-legged stool. The first leg, of course, is Social Security. The second leg is if you have a potential pension from your employer. And that's not as common nowadays, but I know through school districts and universities and things like that, sometimes there is that pension. And number three would be a 457, a 401k, some sort of retirement plan through an employer. So we look at all three of those and see how they all work together. And so, it may be even if you're in your 40s or 30s and you're like, hey, I don't know what my Social Security would even look like. We can pull that. We can pull your Social Security statement with you and we'll plug that in. And secondly, we'll plug your pension in. Then the third thing is let's plug your Roth potential balance that what that's going to look like, 20 years or 10 years from now. And we could actually run an analysis because part of that will be not taxable. Some will be taxable. And of course, it depends. So think about that because your Social Security is not going to be taxable, but your other income could push your Social Security to become taxable. Then you have Roth money coming out, that's going to be tax-free. And then you have pension money that's going to be taxed. So it's important to look at those three-legged stools and sit down and see what that's going to look like for your specific situation.
Thanks, guys. And then one of the other questions is, what if you are self-employed? How do you invest in retirement?
Yeah, so in that situation, there's a lot of different options that we can be looking at. So one example that I'll give you guys here, and there's other ones, but one example is a retirement account called a SEP IRA. A SEP IRA is specifically for folks that are self-employed or sole proprietors, right? That maybe don't work at a company or a school or municipality, but are self-employed, maybe don't have any employees, and need to contribute to a retirement account to get some of those tax benefits and save for retirement. So there's a lot of different options out there for folks that are self-employed. To get more specific, feel free to reach out, but a SEP IRA may be a good thing to research and kind of see how that works.
And earlier, you guys referenced chasing performance as bad behavior. Can you give an example of this behavior?
Yeah, a couple of weeks ago, GameStop. DJ, I'll let you maybe talk a little bit more about that. I'm kidding about that, by the way. But yeah, I mean, chasing performance kind of, it was well shown in that scenario, right? Chasing performance means, hey, I feel that a particular company is in the news and their stock value is going to go down, so maybe this is an opportunity to get in because I feel like maybe they're at the low point and they're going to go up. At the end of the day, when we're trading individuals, and when folks trade individual stocks, you are taking a higher level of risk because we just don't know, right? On a day-to-day basis, we don't know how a particular company will perform, right? Nobody saw the GameStop situation occurring the way it did. That's just an example. But when we're trying to chase performance or time the market, it's just proven time and time again that it's not an effective strategy to build wealth. Will you get lucky once in a while and do well? Maybe. It's the same way folks do well when they go to the roulette table. But when you invest in individual stocks, that is not necessarily, it's more speculating than actually having a strategy in place for growing your wealth down the road.
Thanks, gentlemen. There's a couple of more questions. One of them is, what advice would you give a UCLA staff member that wants to retire early, or actually is retiring early?
Sure. I would advise that person to jot down my email address and my phone number to reach out. And the reason I say that, I'm not, not to joke around, but the reason I say that is because every situation, like we've been saying, is different, right? It's important as a financial advisor, any financial advisor, to understand each individual's certain situation, their need for income when they transition into retirement, explaining to folks how maybe Social Security works from a tax perspective versus other sources of income that they might have, putting together pretty much a plan so folks understand where their income will be coming from when they retire. And that's specifically, like DJ was saying, that's what we specialize in, right? So I would say a simple question, but a loaded answer. So I would say if you'd like to dig in and see if we can help, feel free to reach out.
And David, just to add to what Carl mentioned, it's interesting. We actually have several individuals that we've worked with, both at UCLA, but also at other institutions. And what's interesting is that we see a lot of individuals that have that opportunity to retire early, which is just amazing. But there's also interesting things that happen because we see with a lot of our retirees that are the ability to retire early. Sometimes they'll start their own business or they'll do other things. And so there is still opportunities to generate an income as well as save for retirement. There's some recent changes that have happened where an individual now can take a required minimum distribution later in retirement. There's also some changes where they can actually continue to keep making contributions. And so it's important to take a look at that and see what makes sense, because if someone decides to do early retirement, maybe there's a hobby that also becomes a side business or a personal business, there could be an opportunity to set up a individual or a simplified employee pension plan or something where we do something for the business owner. And so that could be something, and I think that's really coming down to what their goals and objectives are at retirement.
Thanks, gentlemen. We have 3 more questions and 4 more minutes, so I'm sure we can crank this out. I'll give you the easy one first. Does Wescom offer tax advice? Do we do tax advising services, I should say?
You know, I can answer that, Carl, and the answer is no. And in fact, on majority of our brochures, as well as our disclosures and everything, we are not tax advisors. We can give some guidance and some suggestions. I can tell you that Wescom has additional partners that we work with, but unfortunately, we can't give any tax advice. Our real focus is on investment planning and building a strategic plan for you. We have access to some pretty amazing financial planning tools, so we can actually do some, I mean, you call it from Monte Carlo to some stress testing on your portfolio to coming up with a risk score of currently what your portfolio looks like. In fact, we see that with individuals that ask us on their 401ks in retirement, you know, can you take a look at this? What does this look like? What would you do? We can give some guidance there, but from a tax standpoint, unfortunately, we can't give tax advice.
Thanks, DJ. And this one is, what are REITs and where can you go to research them on brokerage sites such as Vanguard, Schwab, Fidelity, etc.?
Yeah, and I know that slide came up and I probably should have spent a little bit more time on that. So basically that's a real estate investment trust. So think of it this way. I mean, as you go out and look at ways to diversify your portfolio, we've always think about just stocks and bonds. But so many individuals do real estate, whether that is, you know, buying a home or buying rental properties or commercial properties, big industrial parks. So what's nice about REITs is it allows an individual investor to actually go out and buy real estate, but you're going to pool your money with other individuals. So instead of buying a big building, you may buy a portion of it because you're one of many thousand investors that are out there. There definitely is risk out there, and there's definitely different types of REITs. There's REITs that are traded on a daily basis. There's some REITs that don't trade, but every quarter, or they don't provide you an update on what the price is of those. And this, what is called private REITs. So just know this, the whole purpose of REITs is not that we're going to put all of our funds in there, not at all. It's to add that asset class, because if I can bring the overall risk of the portfolio down and then still keep the return, a positive return, a good return, that's what we're trying to do with a REIT, is add additional asset classes to the overall diversification of the portfolio. But REITs are something that are available out there. There's a lot of information on them. I definitely would be very careful with them because, again, there is a lot of risk in different REITs. And so you want to make sure you understand how they work. But the biggest concern with REITs would be liquidity. So again, it's a great tool, but it's a tool that needs to be used correctly within a diversified portfolio.
Thanks, DJ. And I saved the best for last. A few people wanted to know, if they're looking for a financial advisor, what makes a good financial advisor and what sets Wescom apart from other financial advisors?
Well, I would say those two questions can go pretty much hand in hand. I think within Wescom, I think the culture of our credit union is very important. Like DJ was saying, we're member oriented, right? So the idea is not, it's not a for-profit institution. So what we're, as you guys can see with seminars like this, especially with us on the investment side, we're big proponents of providing education to folks. The best way that we can help our members and our clients is by educating them on how a lot of this stuff works. So a lot of folks, this isn't things that folks pay attention to or look at every day. Right. And it is something that we pay attention to and look at every day. So our goal is to provide that information and that education to members. And we do that by planning, right? And we try to simplify it as much as we can. And so I think that although that might seem like not the most clever answer, it is very important to understand how these things work and how you can apply them to your own situation. I think by educating and informing members of how they can succeed with their finances, and then maybe if folks are either saving or investing or taking income from their investments, I think having that information, education from us is very important.
Thanks, Carl and DJ. So I put everybody's contact information in the chat if you wanted to follow up with Carl or DJ, or if you have questions for Martha, please feel free to email them, set up an appointment. As Sal had mentioned at the beginning, we wanted to pick some participant winners. So if I call your name out and you're still with us, please direct message me your email address so I can tell you how to get your gift card. The first one is Kelly Fallon, and then Nancy Alfaro, and give me a second while I go through my screen. Sierra Wanden, Alex Bonham, and lastly, Kim M. So congratulations. Like I said, if you guys are still around, please direct message me, and I will send it back over to Sal.
Thank you for that, David. DJ, Carl, great job as always. And I just wanted to wrap up the discussion by just talking about Wescom's relationship with Alumni Association. I just wanted to remind everyone on this presentation that Wescom is the official banking partner of UCLA Alumni. And with that, we're always looking at creating new programs, coming up with great products and services that are targeted and that are important to the Bruin community, such as this presentation tonight. We're looking forward to presenting more financial literacy presentations to this audience in the future with different subjects. But we're here to create a great relationship with the UCLA Alumni Association. And with that, some of the promos and offers that we have that are exclusive to our Wescom members. When you open up a checking and savings account, you can earn up to $500 with Wescom. I listed on the side there what you need to do in order to open up or to qualify for that $500. All you have to do is use the promo code alumni when you're opening up this account, and you'll be eligible to earn up to $500 with the new account. DJ, if you go to the next slide, we have an exclusive offer for for the Bruin community, and it is a 0% interest tech loan. It's a technology loan that you can get from the UCLA computer store. So if you're looking at upgrading some of your tech devices or technology devices, you can come to Wescom and apply for our 0% interest technology loan. Just to give you a little bit more of our contact information and resources that we have here at Wescom. DJ, if we go to the next slide. We've talked about meeting with Carl already and making an appointment with Carl. And then also, we do have our UCLA branch that is open on campus. It's open Monday, Wednesday, and Thursday. Did I get that correct? Is Martha Prado still on?
We're open Monday, Tuesday,
and Thursday. All right,
yeah.
From 10 a.m. to 5 p.m. I just want to introduce the audience here to Martha Prado, our branch manager here at Wescom, and with the UCLA branch. And what we're here to do and what we're here to accomplish with Wescom in creating a relationship with our membership, and specifically with the UCLA alumni community, is creating a great understanding and relationship in tandem with the Alumni Association staff. And we're here to build better lives. We're here to make connections with the UCLA alumni in the Bruin community as a whole and in general, to help you make better make you have a great financial future, and to help educate you so then you're making very cognizant and very intelligent decisions when it comes to your money. That's what we want to do here. We're here to partner with you. We're here to help you, and we're here to make sure that you feel financially secure moving forward throughout the stages in your with your UCLA experience and throughout your life. So Just wanted to say thank you for that. I know I gave a quick introduction to Martha, but she is a resource that's there for you. We want everyone to visit our website at ucla.wescom.org, and there is a special site there for you for alumnus with the /alumni on with UCLA. So we want to thank you again for your time and consideration. We appreciate all the questions and all the participation that was here tonight. And we look forward to speaking to you in the future with this. Like I said, we're building exciting programs, products, and opportunities that's specifically geared towards the UCLA community and the Alumni Association as well. So thank you very much. Have a good evening. I'm going to throw it back to Megan and to help conclude the night.
Thanks, Al. And from the UCLA Alumni Association, thank you again to Wescom for investing in our financial literacy tonight. And thank you all for being here. And again, feel free to reach out to me or any of our panelists with any additional questions or follow-ups. And good night and go Bruins.